We're joined now by Hugh Albert Johnson, who is the chairman and the chief investment officer at Hugh Johnson Advisors. Good morning, Hugh. Thank you for joining us at this leg of the show. What do you actually make of the overall Fed commentary?
Well, there's not a whole lot to make of it. There was no real big surprise. The expectation was clearly for a quarter of a point decline. I think if there was any surprise is that there looks like there's pretty disparate perspectives among the members of the Federal Reserve when you have three dissenting votes. And that's the first time since 2016 that we've seen that much dissension within the Federal Reserve. And then, of course, if you look at very, very carefully at what the forecasts are by the members of the Open Market Committee for interest rates or for further cuts in the federal funds rate, there's a real divide. There's 7 that believe that they're going to cut interest rates another 0.25% by the end of the year, and there's 5 that say that's not going to happen. And I think that really reflects not only dissension, but reflects how difficult it is to have a good, clear idea as to what's going on in the U.S. economy. Some think it's weakening very quickly, that it's slowing down and slowing down too much. Others think that the numbers are pretty impressive and pretty strong, and there's a case on both sides. So there's clearly dissension.
Right, but you think markets completely anticipated what came in, and that's the reason why most asset classes across the globe were flat?
Absolutely. You've got it right on the you hit the nail on the head, and there's not much movement in the markets. The markets really, interestingly enough, particularly the bond market, was statistically discounting that the Federal Reserve would lower rates 0.25% and one time, and maybe there'd be another cut in December or March of next year. But it was a big maybe. And that's why it's exactly what you got. You got 0.25% now, and dissension, or a mixed, or shall we say, a difficult decision with regard to December or March. We're not sure that another cut is coming in December. It's clearly a divided Federal Reserve.
Right. In terms of the rates that are going on in the system for the 10-year yield, for how Dow Jones has been reacting, what do you make of largely the movement in the market? Do you expect that Dow Jones, S&P 500 would continue to make fresh highs?
Yes, I do, and I do over the near term, and I'll tell you a couple of reasons. First of all, on the interest rate side of things, when you look at the yield on a 10-year Treasury, given the idea of either maybe one more cut in the federal funds rate, the level of the 10-year Treasury, the yield on a 10-year Treasury, close to 1.85, 1.9% is not going to change much over the course of the next 3 to 6 months. But I think the stock market is going to move to new highs. The principal reason I think that is prospects for the economy are good, but they're not great. So I think the market might move a little bit higher. But the one thing that's been missing from this bull market in the U.S. is optimism. There's still a very low level of optimism, and bull markets do not end when you have this low a level of optimism. So I think that stocks might move higher, and we'll see an increase in optimism before we see the end of this cycle. So a little bit further to go in the bull market, but interest rates are likely to have peaked right here.
Right. Just a word as far as emerging markets are concerned. What is your view on overall EMs in the current environment? Do you think emerging markets will attract FII flows? No,
I don't. I'll tell you, I've been carefully monitoring the emerging markets for a number of years, and the relative performance of their financial markets is not good. And when I take a look at leading indicators as well as forecasts for the economy of such important places as China, I would include India, although prospects for India are much better than other emerging markets. Quite frankly, the prospects are not particularly good when you compare them to prospects for the U.S. It still seems to me, particularly based on the relative performance of the markets in emerging markets versus the U.S., that the U.S. is still the place to be. I hope that changes, but I don't see that changing in the in the relative performance numbers that I'm looking at right now.
All right, we leave it at there, Hugh. Thank you for joining us this morning, giving us your take on the Federal Reserve. What should the EMs make out of it? That was Hugh Johnson Advisors giving his view on the Federal Reserve.